video, you can always just turn your camera off. Okay, so there we go. So we've now started the recording. So thank you very much, everybody, for joining another one of our monthly webinars to support all of the work that we're doing for net zero agriculture and genuinely sustainable farming. So we know that there's lots and lots of different tools that we need to have in the toolbox, and without doubt, the access to the finance to help support those is pretty key. So I am really, really pleased to have along Brian Richardson, who, as you can see, is UK Head of Agriculture at Virgin Money, who's going to sort of take you through things from the Virgin Money Agri Fund perspective. There are, of course, other banks available that have also got green energy finance, but the Virgin one is really interesting, and it's really, really great to have Brian with us. So I know you're going to run through your presentation. I'm really hoping that you have some questions for him afterwards, because otherwise I'll have to ask lots of questions instead. But we'll stop the webinar when it is time for questions, just in case there is anybody who wants to ask anything that you don't necessarily want to share more widely than this group. Okay, so I'm going to be quiet now, and I'm going to hand over to Brian. So thank you very much.
Thanks very much, Sophie, and good to join everyone this evening. I can't at the moment. I can't see you, but I understand you can see me, which is good. So Agri E-Fund, Sophie just asked me to come on and chat about that. I'll cover one or two of the pertinent areas from a finance point of view we're thinking about at the moment, certainly. My role's Head of Agriculture for Virgin Money. I joined the bank 4 years ago. I'm not a banker by career. I spent the previous 10 years to that running H&H Group at Carlisle, which, as many of you will know, is a very large, UK's largest livestock marketing group. So come very much from a practical background. The bank wanted someone to run their agricultural department who wasn't a banker but brought hopefully a fairly rounded expertise from agribusiness. So that's why I'm here. In terms of Virgin Money, a lot of people, when I chat to them, say, well, you're very new to agriculture. Virgin Money came out of Clydesdale Bank and Yorkshire Bank, which has both been around for a couple of 100 years, so long heritage, particularly in agriculture. The bank acquired Virgin Money 2.5 years ago now, which is the old Northern Rock business. Virgin Money is a very retail and consumer orientated brand, so that was keen in terms of volumes of customers. And 18 months ago, we rebranded the business bank. So that's where Virgin Money comes from, but we've got a long heritage in the agricultural sector. And that accounts for about 17% of our business banking. So it's a very large proportion. It's by far the biggest sector within the bank, and proportionally it'll be the biggest sector of the mainstream banks in terms of the importance of agriculture to the bank. Team of experienced agri managers operating right across the UK. So we have full coverage across the UK, very much specialist in terms of understanding the sector needs. And I think one thing, and part of the reason I joined the bank 4 years ago, was that ambition to grow lending in the sector. So very much focused on that side of it. So as I say, a national team of sector specialists. We added up the other day just the experience we have, and the average of those, the average is 25 years in banking, but 18 years in agricultural banking. So we've got a lot of experience, and something I've certainly focused on in the bank, that if we're going to be in front of agricultural customers, support them, we've got to be able to talk the language. So very much that side, and bringing in that experience and the wider knowledge, and making sure we have good contacts with such as Sophie, but with all the other organisations as well. So, and I spend quite a lot of my time guiding colleagues across the bank in risk and credit in terms of what's happening. I sometimes feel that that's as much about just keeping people calm when they hear the various press about agriculture as anything else. But I think what it provides is that background that agriculture is very much a long-term industry. So avoid being reactionary to immediate events, etc. And the other focus we have, I think, is just being available. And my email and mobile number is on our website. I think I'm probably one of the few in the bank who actually has that, but it does mean that any of our customers can get in touch with us. And I think, for all banks, it's a challenge now in terms of handling those customer calls efficiently when we're looking at costs and everything else. So on agriculture particularly, we do try and be very accessible there. In terms of net zero and where we are, the organisation itself, we want to be operationally net zero by 2030. We're a long way towards that. I think in some ways COVID has helped us in that. We've certainly got a lot less office space than we had 2.5 years ago, as people now much more, like myself, working from home. And then the wider challenge in terms of reduced net financed emissions. So the money we lend out to our customers, not just in business, but in retail as well, that lending to reduce the emissions that accounts from that lending by 50% by 2030. So that's using 2020 as a baseline, and that's a real challenge. And we're very focused on that. I think being part of the Branson network, I think, brings us into that focus around sustainability and net zero as well. So we've certainly as a bank focused very much on that, but I think our colleagues in other banks are on a similar mission really in terms of that side. So what's the drivers for us to do that? Well, it's the right thing to do. I think we all appreciate that in terms of climate and moving things forward. Bank of England challenge, I think, whilst you may feel at times, or it may be perceived at times, that the government isn't actually pulling a lot of levers, one of the big levers they have certainly in finance is the Bank of England, who ultimately manages the regulators we work for. So certainly for the last 2.5 years, I've been answering a lot of questions. We've been doing things like totaling up the amount of estimated emissions from all our lending to agriculture and some other sectors as well. So there's a lot of work being driven by the Bank of England, and they're certainly asking the question, how are you going to reduce emissions of your customers, and how are you going to support them in doing that? And again, like many of the organisations on this call, I suspect shareholder expectations, so those who invest in our business are very much looking at that and our wider ESG, and certainly our annual report every year, more and more of that is given over to reporting the progress we've made and what we're actually doing about net zero and climate change. All that's backed up by the government focus. And of course, it's about supporting customers. I think we've seen a real sea change, particularly in the last 18 months, where customers are coming to us saying, we need to do X or Y. What can you do to support us in that? And we need to make some investments. So there's a lot of drivers pushing us that way. As I say, we start with the first thing. It's the right thing to do, getting that movement forward and the understanding of it. So in terms of specifically agriculture, it's a very key focus for us. And I think when we started looking at this in the bank, effectively 3 years ago, in some real detail, there was 1 or 2 areas of the bank that were picked out in terms of providing that focus and being a bit of an exemplar for the rest of the bank. So mortgages, for example, transport's another area, but agriculture, I think we've led the way within the bank in terms of both in terms of reporting and looking at how we can support that. We all know agriculture represents about 10% of UK emissions, net zero target in England 2040 and Scotland 2045. I think in both cases, those targets came about without a great deal of thought, but they're there now, and that's the challenge we have as an industry. We've obviously got that alongside new agricultural policy, particularly in England, although there's some movement in Scotland as well. And I think it really builds on some of the thoughts I had when I joined the bank, that part of agriculture post-Brexit was very much improving productivity and efficiency on farms, reducing the cost of what we do, and certainly reducing inputs. And I don't think that theme has necessarily changed, but obviously now it's very much linked to that net zero journey. It isn't necessarily, I don't think, about stopping doing things to reduce carbon. I think it's about, you know, producing the same or even more with using less resources, etc. So that's quite important there. So, you know, very much we've had this focus. It's the theme, and you'll see this in our annual report. Agriculture gets quite a lot of mention in there in terms of what we're doing. And talking to my colleagues in other banks, it's a similar theme across all the banks. Agriculture certainly is a focus. It's an area where I think a lot of the measurements are available in one way or another, so we can start to move that forward. I think a big part of this when we started on this journey was understanding emissions in agriculture and how that journey to net zero might be managed. I think when we sat down, certainly when we started, there was a lot of head scratching what it meant. There was lots of different views about this as to what it meant from, you know, we all needed to stop eating meat, etc., and move on to other areas. But that I think through a process of education, we've learned an awful lot. We've partnered up with industry specialists. So we've talked to universities and colleges and brought in experts, but on a practical level, we teamed up with a business called Carbon Metrics, which are on the Lancashire-Cumbria border. Simon Haley, who some of you may well know, is a very well-respected consultant, and he started Carbon Metrics with a focus on really understanding that carbon journey for agriculture and supporting it. His partner and director, Helen Dent, is a trained agronomist. So I think I particularly like this partnership because they're both very practical. They're working directly with farmers. So what we're doing is practical based rather than theoretical. And we've been working with them now for over 2 years in terms of the journey. And that's been great in terms of understanding the challenge, what are potential actions we can take on farm. We've also undertaken training for our agricultural managers, Re-Net Zero. Farm managers, our agricultural managers get to sit down with our farmers once or twice a year, so it's important they can have realistic conversations around that. And one of the early things we did was to carry out a number of farm audits for our customers as pilots. So it was very much an open book. Simon and his team did these audits, went through them with the farmer, and then we were able to use them as examples, talk them through with the farmer in terms of what we might be able to do there. The other thing we did at the same time, we did a survey across a whole bunch of agricultural areas with our customers. We did ask them in terms of carbon and their thoughts on that. At that time, which was January this year, just under 40% of farmers had undertaken a carbon audit. Approximately half of those had been asked to do a carbon audit by one or other of their customers. So that was a big driver for them, but it does mean half of them were doing them independently. There was a high proportion in Scotland. So just over 58% of them were Scotland and 42% England. And I think that's driven by some of the grant and certainly the settler cow scheme in Scotland as well, perhaps a little bit more tied. So I think that there's already been a reasonable uptake in terms of farmers doing a carbon audit to start identifying what needs to be done on the farm. Some of it being driven by customers of the farmers wanting that information. That's particularly so in the milk trade, I think. One of the other questions we asked them within that was very much where were they planning to invest going forward, and there was a high degree of investment, particularly in automation. So 72% were looking at automation, bearing in mind this was January, and thinking about labour shortages, etc. That's perhaps not surprising. And then there was 54% looking at precision farming. So quite a lot focused on investment there. There was also 43% of those farmers looking to plant trees in the next 12 months. I'm not sure whether that is entirely linked to that thought process, but that was certainly what was happening at that time. So that's part of our education, I think, in terms of learning about net zero, about carbon on farm, going through and getting rid of a lot of the myths. From that, we produced a guide for our farmers, and if I say so myself, it's very much intended to be muddy boots, written in a language hopefully they understand. So we've written it alongside carbon metrics, but very, very much using hopefully a farmer's language, pulling all the information together, demything some areas, highlighting other areas that require more research, but I think giving a fairly practical basis to where we can move forward on this and understand it. And I think one thing I pick up very much from farmers is the lack of understanding what carbon means, and we'll come back to that. It's available to download on our website, and we've had a good uptake with that, and certainly it's given us a good background to work on, bringing in all the information we have. So I think in terms of that journey to net zero, the challenge, we certainly have a lack of unified voice around goals for agriculture. As I say, I think the targets of net zero 2040 in England came out. I was at the NFU conference when it was announced 3 years ago, and there hasn't been a lot of sort of follow-up there, and it's tended to move with the economics of agriculture a little bit as well. Huge challenge in terms of having a standardized toolkit to be able to look at how much carbon a farm's producing. I think that's certainly for those who don't feel it's appropriate to move forward and have a distraction of looking at carbon outputs, or feel that we're going at this too fast. I think it gives everyone a good excuse not to do something on the basis that the carbon audits are all going to give different results, and they do, but that's more, I think, about what they're measuring rather than the actual calculations. And some of that is lack of policy development by government. I think government and myself and other heads of agriculture talk regularly with DEFRA particularly, and I think they felt it should be very much market-led and industry-led, and we're hoping for that to happen. But the fact we haven't got any standardisation in terms of audits and measurement, I think now DEFRA is perhaps understanding that a little bit more. But against the background we currently have of significant inflation, I just question if the political drive is perhaps waning a little bit on the net zero ambition in light of inflation. I think Boris again has perhaps got some of the blame for being a great advocate for net zero. And if he's not there, is it going to have quite the same challenge there? And certainly farmers sitting back and waiting, and there's quite a few farmers I think who are waiting either to be told or asked to get involved with carbon. And the other side is the distraction of potential for selling carbon credits. I think a number of farmers are there waiting to see when they can monetize this rather than looking at it supporting their own business. So I think there is a lot of challenge, I think, in terms of selling this story on farm. I think progressive farmers are certainly aware of it and more involved. Certain sectors are more involved, but certainly the dairy sector, I think, is further along than a lot of others. And those farms that have close relationships with their customers and particularly supermarkets, I think, are also further along that route. But the opportunity, I think in the carbon audits we did, there was some very quick wins for the sector on reducing carbon outputs around productivity and efficiency improvements. And that's perhaps not surprising, but I think what the carbon audits have allowed is really a chance to sit down and deep delve in the business. If you've got a good consultant behind it, he's going to be benchmarking that. It is identifying productivity and the efficiency around that farm unit and what can be done smarter, where resources being used are higher than perhaps the average or significantly higher even. So I think that's certainly there. And I think the other side to it is, farmers having a plan. And from my point of view, having any plans better than none, particularly financially. But I think it provides the progressive nature of the sector, that we are moved forward. We do understand the nature of the inputs, and certainly it's better to lead than be told what to do, I think, in terms of that. And I think, yeah, the opportunities are there. I spoke at an SAC beef meeting at Huntley a couple of months ago, and one of the things they did was put all the, what you would expect from a top performing beef unit, and they put all the parameters there, and there was a lot of nodding going on when they put them, and no one disagreed with the numbers being put up. But when they then went on to say, well, how many are actually achieving this, there weren't actually very many achieving it. So I think that identifies the potential to do it. That was in terms of productivity, but of course, extra productivity is going to reduce that carbon output as well. So in terms of our practical response to this, we wanted to create an environment where, when investments could be identified that will reduce carbon on farm, we could actually support that financially, both in terms of incentivized loans, but in terms of how we looked at those loans as well. So not necessarily changing dramatically our normal prudent approach to lending, but certainly being prepared to look very closely at them and understand the wider side. So we introduced 3 months ago the Agri-E Fund, which E standing for environment and efficiency. So it's very much focused around those two. The requirements are that the farmer's undertaken a carbon audit, and from that has identified reductions in carbon that can be achieved by making investment, and that's what the E Fund does. It's incentivized in that we don't charge a fee on it, fee typically being between 1% and 2%, so it's a significant saving in terms of that loan. We require, as I say, a carbon audit. We don't specify which audit is used, but we ask for a recognised carbon audit used, and we ask for it to be done by a recognised consultant as well. So subject to those criteria, subject to coming up with a background that demonstrates that by making that investment, carbon output on that farm will be reduced, we're then prepared to go forward on the basis of a loan. As I say, it's fee-free. We don't stipulate what type of loan it's got to be, so we've created as much flexibility as we can with this loan. The only thing is it needs to be greater than £50,000. So we've made it simple, easily understandable criteria as we can, and we've provided £200 million available for projects. So what does that mean amongst our lending? Well, we really put this at the front of the queue in terms of people coming to us. We will make that money available subject to normal lending criteria, but we will provide these incentivized loans on that basis. So that's given us a real focus. Some of the examples, we've had this running for 3 months now. We have a new dairy unit being built to reduce manpower and improve slurry handling. So that's not only the parlour, it's the building around it. So it's a very significant 7-figure sum, and improving slurry handling at the same time. So it was actually a project that the farm was already looking at. He then overlaid that with the carbon output of the farm, appreciated how much carbon he could reduce, talked to us, and we were able to build this into the Agri-E loan offering. I think in terms of volume, we've had very, very significant interest, perhaps not surprisingly, in terms of where energy prices are in solar and hydro schemes to reduce bought-in energy. I think that the challenge there is actually getting the work done at the moment, but certainly I think it's a real win. And I think when we did the pilot carbon audits, one of the things that every time came up was this thing about producing your own energy and being able to offset the bought-in energy and being able to use it. We've got a very significant number of our farms with renewables on the farm, but quite often, at the time they were built, they were very much tied into feed-in tariffs. Some of them aren't even connected to the farm unit. They're purely for exports off the farm. So it was using the resources rightfully at that time to optimize income. Whereas now, I think without any real direct support in terms of getting them done, solar and hydro and other schemes certainly paying for themselves fairly quickly. So very happy to support that. Equipment around precision application of fertilizer, so that's certainly going on. Beef handling and recording system. We've got a large beef unit in the south of Scotland, which I think has demonstrated very clearly that through regular recording of animals, better handling systems, then growth rates can be significantly improved overall. Early sale of animals that aren't performing, etc. So again, that's an example where it can come in. And then improved chicken shed ventilation to improve growth rates and potentially reduce mortality as well. So that, again, fairly straightforward there. And then slurry acidification, which I think again is a double win. It's improving growth rates of the piglet. It's also then delivering a much better fertilizer product at the end of it. So all those, this is what I mean about the scheme being very broad. All those would come under the Agri Fund. We can provide funding for that, and it gives us a very broad tablet to work to. I think just in terms of, so we've got that going on, but then just in terms of general banking support to finish off on, we've obviously got ag inflation at the moment. I say creating some challenges for 2023 and beyond. That's probably a huge understatement. I think we've been looking at this all year really, and obviously concerned about it, particularly around energy, but in agriculture that leads through into other areas. We've got significant inflation in fertilizer, and that I think is now moving further up in price. We've got the Anderson's data suggesting agflation running at 28.8%, and output prices lagging behind. I put on there 2023 and beyond. I think ourselves, and without speaking for the other banks, I think generally when we're on calls together, we have a similar view. We haven't really seen any great uptake and demand for overdraft utilisation at the moment or more. I think there's a lot more talk about we will need some more money in the autumn and certainly into next year to fund the crops that are going to go in the ground this autumn, but also then to see through in the new year. So it's going to be a challenge. I think we have the benefit that most sectors have had a reasonable last 24 months in terms of profitability and income, so they're not going into this after previous challenges. We've also to date had a fairly low cost harvest, so which using a lot less energy. So I think that there is going to be an awful lot of challenge. We're seeing, and everyone is seeing, these very high increases in energy prices starting to come through. It does seem as though a lot of farmers this autumn will be renewing electric contracts at 200%, 300% and 400% increases, depending where they started from. I was with a potato producer in Scotland last week, and his bill for his potato store and farm will go up £70,000, which is equivalent to about £25 a tonne of potatoes he's producing. So very significant impacts there. Of course, it's not just a case of being able to pass it on to the end consumer, because it does depend on demand and supply and what the markets are doing. But farms are going to be squeezed next year. So it will depend a lot on what output prices are, where they end up, and also if farmers are able to do anything to mitigate the amount of energy they're actually using. So I think our message around that is very much important for farmers to plan and cash flow. as I say, I think certainly more progressive farmers and some of the smaller farmers actually have already been on to us saying, they'd like to have some flexibility in their overdraft facility so they can cope with this in the autumn. And at the same time, in England, we've got a further 15% reduction in BPS payments without necessarily those being replaced in other schemes at the moment. So I think around that, it's very much, we recognise this as a long-term business. I think as a bank and the banking sector generally, I think we are supportive of the ups and downs of the industry and will be supportive, but there is going to be some particular challenges there. And I think the challenges will be even greater where people literally bury their head in the sand and wait for something to happen and hope that output prices are going to get them out of jail, really. Another challenge at the moment is obviously the higher interest rates that need to be understood and built into future plans. Agriculture is an interesting sector that it is very lowly geared, less than 10% gearing in the industry, but and a significant proportion, something around 50% of farmers don't actually borrow any money at all. But others obviously do, and more intensive farmers certainly will have borrowings there. So interest rates play a key part in that. I did just ask our colleagues in our Treasury department just to give me a couple of slides, just in terms of where interest rates are going. It's normally an area I get asked about. So base rate currently 1.75%. What this graph is showing is each of the Monetary Policy Committee meetings up until the 3rd of August next year, and the expectation from the experts, the economists, as to what will actually happen during that period. So you can see there the next meeting's due on 15th of September, and there's an expectation that interest rates could rise to 2.5% there. And then in November, just below 3%. In December, 3.5%, and then into next year, really somewhere around 4.5%, 4.75%. So that's the consensus across the city at the moment as to what the Monetary Policy Committee will do. I got quoted in one of the Scottish farming papers that I didn't see a return to the old days where we had interest rates well over 10%. Well, frankly, it's not for me to be able to predict that. I'm not that clever, but this is where the economists are seeing it, and you can see there what their expectations are of the Monetary Policy Committee. So unless the new leader of or the new Prime Minister has different ideas, then that's the likely direction of travel coming up. If you then overlay that with swap rates, so effectively if you want to go out and fix your money for the next 5 years, as you might do a mortgage, but you can certainly do that with business loans and do it with a swap, so pay a premium for a swap. This is the indications of where these rates are going to be. So if you looked back to January of this year, you would have been able to fix your money forward at something like 1.5%. You can see how that's gone up, and the recent peak in the last 2 weeks where we're now looking at just over 3.5%. So very significant increases. I think what it's actually also indicating is that the short-term rates, when you transfer those through to 5 years, at the moment, those experts don't really see them going a lot higher than that. And certainly if you then look at the 10 and 15-year swap rates, they're slightly below these levels. So there is perhaps a little bit of positivity there in terms of that. You can look at these in a positive way, but there are going to be higher interest rates. And of course, this is just looking at the base rate, and there's a premium on top of that to go. So we're always very prudent in our lending, so we always make sure that anyone borrowing has headroom to be able to cope with higher interest rates. We have had very low interest rates for a prolonged period of time, so we will no doubt be reviewing where we are in terms of that affordability criteria and building in potentially higher interest rates going forward, so the affordability to be able to pay for those. So just coming back to some of the areas there, I think higher interest rates certainly going to be a feature. I certainly feel in talking to a lot of farmers, those that are nearer the end market for their produce are better positioned to succeed in the longer term. I think those that are just price takers and literally delivering to second or even third party suppliers, have that challenge. I think this is where, potentially the dairy industry has an advantage. Those producers are very close to their end markets and their processors. So I think one thing we will see is more farmers getting closer to the end market. The adaptability of farmers, I think that there will be a lot of change to come. They will need to be particularly adaptable and move and prepared to understand all these new challenges coming along, whether it be net zero, whether it be high interest rates, whether it be changes in what's happening. Personally, I feel we're going to be producing in the next years the same amount of food, but from fewer acres. And those acres that are put to one side will go into environmental schemes and elms, etc. And I mentioned earlier about more trees being planted, and certainly that's part of the case. But I think the overall food totals will go on. There'll just be fewer farmers producing it. And I think there is a big opportunity here for UK agriculture to be more productive and efficient, and farmers need to better understand the opportunities from achieving those improvements. And I think it is a difficult message. I have been shot down once or twice for talking about productivity and the improvements. I fully appreciate farming is a really challenging job, but and I have been directly involved in farming myself, so I don't decry the effort, but I think across our farming industry there is a tremendous variation from the world-beating farmers down to some who perhaps have a bit of room of improvement. I think as we go through the challenges in the next few years and meeting the net zero requirements, I think we are going to need to deliver that more and more. So that's a bit about the e-fund, bit about banking and interest rates, and just a few thoughts, but happy to answer any questions. As I say, we've got a fairly tight team across the country. Certainly, Sophie will share these with you, but Stephen Buchan looks after Scotland and Oliver Maxey for England. So between the three of us, we can cover any requirements that England has. So if you do have any needs there, please do give us a call. So Sophie, I hope that's okay, and back over to you.
Thank you very much indeed. Thank you. So yes, well, we know there's some incredibly challenging times, but I think that was very helpful. And also I did really appreciate the realistic but bleak forecast that we're looking at in terms of interest rates, but knowing where things are potentially heading and being able to incorporate that into a plan is absolutely essential, so and to be able to sort of understand how it can work together. So it would be really great if anybody has any questions. You can actually just put your hand up, or you can also just unmute yourself and ask if you feel more comfortable to do that. I am going to stop recording though now, just so we can have that discussion. So she says, if I can actually work out how to do it. There you go. So